Welcome back, guys. Happy May to you all. I've got some technicals for you on what's going on in this spring market, so let's get started. Overall, our buyer activity and time on market for 2023 spring market is comparable to 2019. The season of March to April increases in sales activity was lower than normal, and sales volume is down compared to the last year. It's been driven by interest rates and continued affordability challenges. Year-over-year data can be confusing as reduced activity makes our regional market look weaker than it is, when in fact inventory remains low and competition high. Freddie Mac analysis cited that interested home buyers are acclimating to the current rate environment, but the lack of inventory remains a primary obstacle to affordability. These key factors will foster an environment where home values will remain relatively stable. Compared to before the pandemic, the median price is still nearly 30% higher, and supply is less than half of what it was pre-pandemic. The Bright MLS Home Demand Index for the Washington metro area rose 3.4% in April, increasing for the fourth month in a row. Levels indicate a steady pace of buyer demand, with luxury condos and single-family homes being the most popular. Inventory is still low, with month supply sitting around 1.2 months for single-family homes priced between $5 and $1.2 million. Buyers shopping under the $500K price point will face similar challenges, with a 1.6 months worth of inventory available. As far as the availability challenges go, experts are predicting some slow but continued relief on the mortgage rates front. Earlier in May, a 10th straight hike brought us to a 16-year high of the federal funds rate. The following release of May's CPI data gives us a 12-month comparison of inflation averages following the start of the Fed's rate hikes. The most recent CPI report shows inflation is at a 4.9 year over year, which is slightly below the predicted 5%. The PPI report was at its lowest reading since January of 2021. Both these measures signal to investors that the Fed's attempt to control inflation is starting to make headway. These measures will still face some challenges, with the job market reporting being strong, with a higher than predicted number of new jobs, lower unemployment rates than anticipated, and salaries increasing 0.2% more than the year-over-year projections. So, despite the employment data, investors are regaining confidence in long-term investments. It is further evident in the drop of the 10-year Treasury yield, which reflects a shift towards long-term investments. This was also driven in part by the volatility in the banking world, as First Republic Bank was taken over by the FDIC and sold to JP Morgan Chase. As the Fed continues to dampen inflation and long-term investment strategies reverse the inverted yield curve, we are more likely to see steady decreases rather than sharp increases in mortgage rates. Better rates will help affordability amidst tightening inventory, and steady the increasing home values. If you're looking to buy or sell, my best recommendation is to start building your real estate team of professionals early on. Combining a knowledgeable agent with a lending partner who is well-versed in the mortgage market and loan programs will help you to put together the best strategy for buying and selling your home. Thank you so much, guys, for listening. As always, I'm never too busy for questions. I've added some resources to your e-report if you want to know more. Have an amazing May. Take care.